Half of what your parents taught you about money is wrong. Not because they lied, because the rules changed. Today we are debunking 10 of the most persistent personal finance myths with real numbers, and by the end you will know which ones to stop repeating and which ones are costing you the most. Welcome to the Money Mind. Every one of these myths sounds reasonable. Most of them used to be true. But the economy, the tax code, and the tools we have today are not the same as they were 20 years ago, and outdated advice is still advice. It is just more expensive. Let us go. Myth number 1. A house is always a great investment. It can be. It often is not. Once you add property taxes, insurance, maintenance, closing costs, and mortgage interest, the real return on most homes over the long run is closer to inflation than to the stock market. A house is like a car you can also live in. You need shelter either way, but calling it an investment without subtracting the costs is how people end up house poor. Own a home because you want stability, not because you think it is guaranteed to make you rich. Myth number 2. Renting is throwing money away. Every dollar of mortgage interest, every property tax payment, every roof repair, every realtor fee is also money you never see again. In high-cost cities, renting and investing the difference has beaten buying for the last 15 years. The real question is not rent versus buy. It is what is the total cost to stay in this home for 10 years, and what could that money have done somewhere else? Sometimes buying wins. Sometimes renting wins. The label is the myth. Myth number 3. Student loans are good debt and all other debt is bad. The good debt, bad debt line was drawn when student loan rates were 3% and homes appreciated every year. Today, some federal student loans are near 7%. Some mortgages are near 7%. Some auto loans are near 4%. The label does not tell you the cost. The interest rate does. Good debt is not a category. It is a calculation, and it changes with the environment. Myth number 4. Cut your coffee, and you will retire rich. $5 a day invested for 40 years at an 8% return is roughly $500,000. That is real. But this myth is used to distract you from the two levers that actually move the needle: income and housing. You can skip coffee for 30 years and not recover from one oversized mortgage. Small wins are good. Just do not let them replace the big decisions. Myth number 5. You need a detailed budget tracked to the penny. A budget is like a diet. The one you actually follow is better than the perfect one you abandon in 3 weeks. For most people, 3 buckets work better than 40 categories. Fixed costs, savings and debt, everything else. If the one flexible category does not run out by the end of the month, you are winning. Complexity is not the same as control. Myth number 6. Carry a small credit card balance to build your credit score. This one genuinely will not die. There is no version of the credit score formula that rewards you for paying interest. Your score looks at utilization, which is your balance compared to your limit on the day the statement cuts. Pay your card in full before the statement, and your utilization still reports. You get the score boost without donating money to the bank. The myth costs the average cardholder hundreds of dollars a year. Myth number 7. Closing an old credit card helps your credit. Usually, it does the opposite. Closing a card drops your total available credit, which spikes your utilization percentage, which can tank your score overnight. It can also shorten your average account age if it was one of your oldest cards. If the card has no annual fee, leaving it open with a small recurring charge on autopay is almost always the stronger move. Close cards for your sanity, not for your credit score. Myth number 8. You can time the market if you pay attention. Academic study after academic study says the same thing. The 10 best days in the market over a 20-year stretch account for roughly half of the total return. And those 10 days almost always happen within weeks of the worst days. Missing both is a coin flip. Missing the best ones by sitting in cash is what actually wrecks portfolios. Boring monthly investing beats brilliant timing for almost everyone. Myth number 9. You need a lot of money to start investing. Fractional shares, index funds, no minimum brokerage accounts. Every reason this myth was ever true has been removed in the last 10 years. $20 a week into a low-cost index fund over a working career is a life-changing sum of money. The obstacle is not the minimum deposit. It is the belief that it is not worth starting until you have more. The earlier you start, the less you need to save later. Myth number 10. If I just made more money, my problems would go away. There is a real floor below which this is true. Below a living wage, more income is the answer. Above that floor, the pattern is almost comical. Income goes up, lifestyle goes up by the same amount, and the financial stress stays exactly the same. Lifestyle inflation is the silent undoing of every raise you have ever had. The people who actually build wealth keep their spending roughly flat while their income grows, and they let the gap do the work. Here is the common thread across all 10. Every one of these myths was probably true at some point. The economy changed, the tax code changed, the tools changed, the advice did not. The smartest money move you can make this year is to audit the rules you grew up believing and ask one question about each. Is this still true for me in this economy with these interest rates at this stage of life? If the honest answer is no, that is a myth worth letting die. If one of these hit home for you, drop the number in the comments. Which myth did you believe the longest? Subscribe for more no fluff, no hype, research-backed money breakdowns. I am the Money Mind. Let us keep building.